Okay, it's about time, so I will just start on today's sections. And since we already go through so many fundamental lessons that are talking about the basic theory of how everything is going on, and then now we are going to start on the first step, which is I will guide you step by step throughout how do we able to make money. And then the first step will be choosing the assets and the options. Before we start, in case that there is some new attendees that joining us, I will just give a brief introduction to myself to all of you. My name is Jun Lo, and you can call me Jay or you can call me Xiao He Lao Si. It's all up to you. And then I have 4 years of experience in fund management, 2 years specialized in building the algo bot, a custom algo bot, and then using the algo bot to make money. And I have achieved an annual return around 26 to 33% across this year. And then now I'm a new joint trainer, a financial analyst for uSMART. uSMART is a really great company that is offering a very professional trading platform to all the people around. So before I start this class, I will just give a little bit disclaimer, which in this class, we are not going to upsell you any courses. We are not going to give you some personal coaching sessions. And then I will not collect any of your personal information and your money. So if there is someone else come to approach you to get all the information or money from you, be aware, because it will not be me, and it might be someone who is using our name to cheat on you to get your money and your informations. And then our goal is to make sure that we deliver the correct information and the knowledge to all the public so that we can become a financial expert together. And hopefully we can make it from a total beginner to become a financial expert, one step by step all together, and then we can finally make some money, and maybe to just gain some pocket money, or the ultimate goal will be get retired earlier. So before that, we already talked about the introductions to the options, which is the call options, the put options, and all the strategy that apply for different volatility market. And then for the ranging market, we have iron condor and the credit spread. And then for the trending market, we will have the debit spread and also the long call and the long put. And beside that, we also have the straddle and strangle, which is to make money from the huge volatility. And this is all the strategy are going to apply. Now, how do we start? How do we identify the market conditions and choosing the correct assets to trade? And then inside the underlying assets, what is the options that is more suitable for us among all of those? Because all the options have different expiration dates, different strike price, and also the grid value are different, which it make it very difficult to choose the best options that fit us. And it depends on the risk tolerance, so it will have a different preference for each other. So it won't be a perfect options, but it must be options that fit you the most. But first of all, if you are aware of all the risks and you know about all the strategy and you prepare the money, now you wonder how to get started on your trading journey. So you want to get started on your trading journey, and you are very confused when you open up the trading interface. And now I will just going to teach you how do you choose the asset and how do you choose the option that fit you the most. Because this will be the first step. And then what coming afterwards is your P&L. And now we need to take the first step first before everything. And I'm going to give you the lessons to teach you about all of those. So now we are going to talk about how do we choose the correct asset and also the options. For the stock, before we go into the detail, we need to know either we need to choose the option first or we choose the asset first. But it will be very difficult and complicated if you just choose the option first and then you refer back to the stock itself, because the option price will be greatly depending on the stock price. And there will be many factors that affecting the option price, such as the delta, vega, theta, the time decay, the volatilities. So the chart for the options and the information from the options might not be appropriate if you just choose the option first and then you go back and refer to the stock. So I would suggest you, which is my common practice, is to look at the stock first. You select the most suitable stock among the market, and then you only choose the option that provided by the stock with different strike price and different expiration date, and then you just choose the options. So please be aware that choosing the underlying asset first will be the first step, then you will only look for the options. Because whatever happened on the stock price will affect the option price, but whatever happened on the options doesn't affect the stock price. It is like a mother and son, which the stock is the mother and then the option is the son. And mother affect the son, whereby the son, no matter what the son did, it doesn't affect the mother. So please be aware on that. So we will just go into how to choose the correct mother. For us, we are unable to choose the mother for ourselves, but in the financial world, we're able to start from that. Okay, when it comes to choosing a stock, this will be what you need to pay attention to. The first one is the volume, and the second will be the trend, which we will need a high volume stock, so that this is a common practice that the stock that trading in a high volume will be more likely to have a movement. You have a higher volatility, and also the higher volume will make it provide more options for you to choose. The options that is available will be varies comparing to those that have limited volume. So make sure that you are going to choose the stock with a higher volume and then have a clear directions, the clear trend. Whichever stock that can just make you to know the direction at the first glance and without any thinking, without using your brain, that will be the ideal stock. Because when you take a look at it, then you know it is uptrend or downtrend. If you take a look at it and you are not sure about which direction is going to head off, then it might not be a correct option for it might not be a correct asset for you. It makes you very difficult to make the judgment, and then the uncertainty is way too much, and then the probability that is heading off in a very clear direction is unclear. So make sure that you are choosing a stock with a high volume so that you can get in and get out without any problem, and then you have more options to choose. And then make sure that that stock itself have a very clear trend, either it's in the uptrend or a downtrend. Because in this case, we are going to talk about just a single leg options without talking about the multi-leg strategy. So in this case, we are not going to trade for the ranging market. We as a beginner are going to start with the trending market. Be friend to the trend and make money along it. That is the easiest ways to make money from the financial world. So now I'll just show you how are we going to pick a stock among all of those selections from the financial world. And in this case, we are only focusing on the US stock, but you can apply the same, just make a little bit adjustment so it can just fit to different market. But that adjustment will be greatly depending on yourself. Okay, so let's start on how are we going to select the options based on these two factors. And I will just show you the way that I did to make all those selections. Okay, so first of all, open up a TradingView, tradingview.com. This is the best free public accessible website that can allow you to make your technical analysis and make the screening across all the market. So go to tradingview.com and then you can register yourself an account. It's free, but you can also upgrade to a membership account with a little bit pay annually, I guess, and then you can access to more functions. But in this case, the free account will be enough for our studies. Okay, first of all, you will see this interface, and then you will need to go into the chart mode before anything. So you can just randomly search any stock. In this case, you click on the search button on top and then you key in something else. Then it will show up something like this, and you can just pick whatever that you want, and then it will just directly transfer you into the chart mode. And in this chart mode, you can see the chart itself, and you can add the indicators, the alert, the replay functions, and you can see that the below bar is the time, and also you can check on the price, and also there's a lot of drawings tools that are available for you to draw. And when you check on the left bottom, there is a button for a stock screener, which is the tool that we are going to use for this class. So now we will need to start on how do we do a stock screening, and then we will just apply different factors to filter out all those stocks to choose the best stock that provide us a very clear directions, so we can just get along with the trend and make some money. So now you click on the stock screener and you will see something like this, which is the stock screener function that provided by the tradingview.com. And then you can check on the overview column, and then when you click on the overview button, it will show on the filter by default, and you can see that there's a lot of filter by default which rank it according to the performance, the extended hours, the valuations, the dividend, the margin, the income statement, the balance sheet, the oscillators. The oscillator, which means it helps you to identify the best timing for entry and exit. Oscillators, which is the general technical indicator that help you to identify the overbought and oversold zone. And then usually we will just use it as a perfect timing for entry and exit, but not to identify the directions. For direction, you might need something else like the MACD, EMA. Those will help you in identify the directions, and then the oscillator will help you for the entry. So in this case, we will need to know which stock provide the strongest directional movement first. So we are going to use the default trend following functions. So we will choose on the trend following functions to know the ranking by itself. And when we click on the trend following, it will just move on from an overview screener to become a trend following screener. And in this trend following screener, you can see there is a moving average rating, and there will be a lot of rating here which rank it according to the strong buy, the neutral, the sell, and the strong sell. And how does it identify the direction? It's easy. It's arrange the ranking according to the SMA, which is the default screener actually using the moving average 20, the moving average 50, and the moving average 200. And when all of those are lining up together through upward, then it will be a strong buy. But if one of the lines are just messing with the others, and it will become slightly lower, maybe a buy or neutral. But when the SMA 20 is below 50 and the 50 is below the 200, then which means that it is in a very clear downtrend, and that will rank it to the strong sell. So this is how the strong buy, the buy, the neutral, the sell, and the strong sell mean. Strong buy, which means that the SMA 20 is above the 50 and the 50 is above the 200. And I will not explain about what is a MA and EMA in this case, because this is all about technical analysis that we will just going to conduct another deeper sections on a future class. But in this case, we are just going to talk about how do we make the first step on selecting the most suitable stock and options before we start our trading journal. And we were just using the default rating system by the tradingview.com so that we don't need to bother about the direction. Since there's already existing system, a very perfect rating system for us to use, why don't we just use them, and why do we bother to make ourselves one? So in this case, we are going to click on the trend following screener, and then we will see the moving average rating here. But you can see there's a lot of stock that is matching to our rating system. There are like 18,000 of the stock. So we need to lower down the quantity that is matching it. How do we do it? Because we already talked about what do we need to see from the stock is actually the volume and the trend. Now we already got the trend. The moving average rating will give us the strength of the trend, which the strong buy will give us a very clear direction, upward direction, and the strong sell give us a very strong downfall directions. So in this case, we already settled about the trend. Now, what do we need to worry is the volume. So we click on the filter here, and it will go into the general filter. And in this case, we are just going to trade for stock, because stock itself is the most simple and most easier starting point for us to start with. So before we get into ETF and all those, we will just go with common stock first. And then this is the default setting by itself, which it doesn't have any filter. And in this case, we need to filter out the potential stock among all of those. So we will just adjust it according to something like this. For the market cap, we will need it to be minimum 100 billion. What is the reason of doing so? Because for those stocks which have a lower market cap, will tend to have a lesser option choice. Please do remember that after we select the stock, we will need to check for the options. So for those who have a lower and lesser market cap, will tend to have a lower availability of options. So we will need to choose those stocks that have a market cap above 100 billion. In this way, we are able to access to more availability of the options, and we can have a very high liquidity in trading in and out, entry and exit without any problem. So if you are going to just trade those stocks with the options, but have a lower market cap, there might be a situation where you're able to get in, but once you want to get out, there's no seller or buyer want to take over. So you're unable to get out, and you can only wait for expiration, or you can only get out at a very ugly price. So this is all to avoid those cases to happen. So we will need to make sure we're choosing the market cap above 100 billion, and then afterwards we'll adjust the volume to minimum 1 million. And for the average volume for 10 days, 30 days, and 60 days, will be all required to be above 1 million. And you might be wonder why is the 1 million? Because we need high volume for us to get in and get out without any problem. For those stocks that have a very high trading volume, the option, the respective options will also tend to have a higher volume in trading. So we'll just filter out for those have a higher market cap and higher trading volume, so we can get involved into those active trading stock. So in this case, I need all of those to be above a 1 million trading volume. Why do I need it to be average volumes for 60 days also above 1 million? Because there might be a case that there's a news release, there's some financial report, so there might be some specific days that for some individual stock to just spike up and have some huge volume. And we want to avoid for selecting on those share, so we'll just make it the average need to be above 1 million, so we can avoid the incidents like those that have some spicy news, some earning report release, those for those that is unlikely to be traded stock to get involved into our filter. So we will just make all the average to be above 1 million, so that I can make sure that this share itself have a very high market cap, so that we can have more availability of the options. And then across the 60 days, there is a higher trading volume. So it's unlikely to get trapped into a position. We can just get access to the position in and out very easily. And afterwards, we will just look at the exponential moving average. In this case, it's up to your preference. You may adjust it, but I didn't do it because I already used the TradingView default filter, which is the moving average ranking. So if you are not using the default filter, you might adjust to your own personal preference, and then you can use the EMA to identify the trend. But in this case, we are using the default TradingView filter, so we will just keep this empty. And now you can see that after we put in this filter, you can see that previously we have a 18,000 matching, and now it reduced to 99 match. But this is still a lot to look at. You need to look at a 99 matches stock, and then you need to check on the price movement and also the options. It is a very tedious work. So we want to reduce it furthermore. So we will just put in more filter, which means less options. Okay. And then in this case, for the 99 matches, we need to have a very clear direction. So we will just put a filter on the moving average rating into only strong buy and strong sell. So in this case, we avoid the trading those in the zone. Those are ranging. For the neutral and the buy and sell, the chart pattern might be ranging in a mess, like the moving average is crossing each other. So after we put in the filter on the moving average, only strong buy and strong sell, those will have a very clear direction, either it's moving up or down. Because we want to avoid getting trapped since we are using a single leg trading options. And now you see that after we apply only those shares with a very clear direction, the tickers is now reduced to 84. But it's still quite a lot for me to look at. So yeah, let's put on more filter to just reduce the matches. And now what to do? We already take care of the trend and the volume. So we will just put in extra filter. And the filter that I'm going to choose is called beta. What does beta mean? a beta equal to 1, which means that this share itself is moving exactly having the same volatility as the SP 500. So for beta equal to 1, which means that it having the same volatility as the market average. So since we want those share that is actively trading, so it will just tend to have a higher volume and a higher movement, a higher volatility. That means we need to put on a filter for, personally I was using a beta above 1.2, which means that it's 20% more volatile when it comparing to the market. But if you are just going to use those strategies like iron condo and also the credit put spread, which doesn't expect the price to touch on your strike price, and you may choose the beta below 1, maybe 0.8 or 0.6, which means that those stocks are likely to tend to have a smaller movement across the year, and it will just get trapped on the zone for a very long period of time. So in this case, we want to trade those with have a high volatility and a very clear direction trend. We will just put on the beta above 1.2. It means that we want those stocks which is 20% more volatile when it comparing to the S&P 500, which means it's 20% more volatile when comparing to the market average. Now, the matches get to reduce from 84 to 22. And 22 is really a very good number for you to screen on. In my case, I will just check on every 22 to select the best stock that have the very clear and beautiful chart pattern. But you can actually reduce the 22 matches to even lesser. And you can see that now we already put on 8 custom filter and total and plus on the default filter of the moving average provided by TradingView, which is 9 filter to just screen out all those actively traded stock which have a higher volume, a higher capital cap, a higher volatility, and also have a clear directions. This is what are we going to trade off. So this will be the filter that we put onto, and you can just take a screenshot or just write it down if you want to. And this is for my own preference, so you may make your custom filter, but this will be what I suggested to look for. For the simple, you can just check on the common stock, but if your risk tolerance is a little bit lower, you may check on the ETF, because ETF tend to have a lower volatility and also tend to have a more stable price movement. And then we will look for those have a higher market cap. In my case, I will look for those above 100 billions. So there will be more selections on the options. And then we will just check on the volume and the average volume to be traded above 1 million. So in this case, you can just filter out those stocks that is affected by the earning release and also those like affected by news. You can make sure that the stock that you are selecting is actively trading across past 2 months. And you can join the trend, you can join the rally in the future. Then the MA rating, which is by default set, which is the one of the default filter by TradingView, I only select those have a strong buy and strong sell suggested. So I can avoid those have unclear directions, which is the buy and sell, and also those have a neutral rating. The neutral rating are usually those that is trapped in the zone, and those buy and sell, it might be a starting zone for a rocket, or it might be reversing. So only those have a strong buy and strong sell rating are those that is confirmed to have a clear directions. Then the last one is the beta, which I would suggest it to put above 1.2. Beta is again represent the volatility of the market. Beta equal to 1, which means that the stock is having the exact same volatility as the market average, the SP 500. And in this case, we want those stock which is very hot, very actively traded. So we want it to be 20% more volatile when comparing to the market average. And you may take a screenshot of it and you may add on, or you just reduce the filter that we put into. In this case, you can check on the volume. We want the average 60 days volume to be above 1 million, which means that we are high likely to just skip on the first ride of the trend, and then even though we miss on the first ride, we want to join the second ride. Okay, now we already have a list of shares to look at, and you can just put another filter. This is up to your choice, but personally I will do it because usually the share price will have a relationship to the premium of the options, the premium price of the options. Even though it may not be true, but it's high likely to have some relationship to it. Those who have those shares that is more expensive, the options will likely to have a higher price also. So in this case, I will just put in the filter because as a beginner, we want to start cheap. We want to start with a lower cost. So we choose those that is cheaper, and then among all the 22 shares, there is four below $100, which is UBS, the Platin, and also Intel and Uber. And now I'll just show you how to check on the options. There's a lot of options available, and now we already have the diamond in hand, the diamond stock in hand. We choose 4 out of 18,000. Previously is 22. If you doesn't care to just invest with a higher cost, then it will be 22. You can just invest in those that is more expensive and put in a higher cost to trade the options. But if you want to start cheap, then we can only have 4 selections among the 18,000 shares in the market. Okay, now let's check on these 4 shares. And this is the comparison that I'll show you for the top 4 that among the 22. You can see that the price is above $100. The first one is 183 and the second is 795, which is very expensive for Netflix. And you can see that if you check on the option price itself, it's also very expensive. For Broadcom, the premium is $13 for each share. So if you want to buy one contract, it will cost you $1,300 to just execute, to just buy on the call. And for Netflix, the premium is $28.96, which means when you want to buy one contract for Netflix, it will cost you $2,896 because one option equal to 100 shares. And you can see that the minimum premium that you need to pay for this will be $990, which is very expensive for new beginner like us. So I make a comparison, and it have an unclear relationship, but you can see that for those stock which is cheaper will tend to have a lower premium price. For the UBS, the call option only costs you $1.52 for each share. So you buy in one option contract for the UBS, it will cost you just $152. When you're comparing to Netflix, it's like 2,800 something. It's very ridiculous. And then for the Paladin, you can see that the premium is placing on $4.70. So when you buy in one contract for Paladin, you will need to pay for $470. And you can see that if you want to start cheap and start low, you can filter out those that is very expensive share price. So now we want to start cheap, so we only look into the option for these 4 share. So we will just start with UBS, and then we will just place the order according to the ranking, which for the strong buy, now we need to choose the options. We already have the 4 stock on hand, the 4 diamond stock on hand, which is cheap and then easy accessible, and then have a clear direction, high trading volume. Now we need to look for the best option that fit our risk tolerance and our preference. And for UBS, the bias will be call, and for Uber, only Uber is the bias will be put, because the rating suggests to have a strong sell, and put is for the bear market and call is for the bull market. So we will just place the order according to the ranking suggested. And now we will need to look for the options for UBS. When you click, okay, now you need to open your trading interface, and you look for UBS group. And in this case, you can just check on whether you are looking at the correct stock or not, and then you make sure that yes, this case we are looking for UBS. And then on the bottom, you can click on the options, and there's a more selection there. So you click on the option and click on the more to access to the list of options available. And in this list, you can know that this is the total available options for us to choose. And we need to choose the options among all of those. Now, we need to filter out from the expiration first. The number in the bracket is the day until expiration. So example for the first one, the number in the bracket is 3, which means that they have 3 days left until expiration. And normally, when we do our options, we are going to choose those options that is going to expire in 1 to 2 months. Because for the last month, the data, the time decay will be accelerated. So personally, I would prefer options for 2 months, and then I will not hold it until expiration. I will just get in and get out, maybe and holding for two weeks or 1 month. So those options that have a 45 days, which is 1.5 months, and also 66 days, which is more than 2 months, will be the best choice among all of those. Because if you're choosing this option with 45 days until expiration, then you can just avoid the acceleration time decay. The time decay will be accelerated at the last month, which means even though you get in now, you still have 2 more weeks until the time decay to happen. And then you can just get in and get out in this 2 weeks time. Okay, now let's look for the first one first. For the option that is going to expire at 2024, December 27, which is the 1.5 months options, you can just, the first thing that we need to check for is the volume. And then the best way to check on the volume is you click on the at the money option, the at the money strike price, In this case, it's 32. And then you can check on the quotation of it. And then you need to look for the open interest. What does an open interest mean? Actually, an open interest is how many positions opening right now. And in this case, there's no contract opening right now. So that it means that nobody is having an options on hand. There's no player in this option, in this share price. So in this option, it's actually dead. So even though you get in now, there will be no seller to sell to you. And even though you want to get out, there will be no buyer to buy it from you. So in this case, we don't go for this strike price. We don't go for this option. And beside that, you can also check for the volume. The volume here is actually the volume traded. And also you can, if you check on the volume traded, there is no trading volume at all for this option. Even though this UBS itself, the mother itself, have a high trading volume, but the options have no one to trade. So we would like to avoid these share options. Okay, now let's look at another options, which is 2 months until expiration. The one that is going to expire on 2025, January 17. Will it be a different case? When you check on the open interest, there is a 1,650 contract that is opening right now. The open interest, you can also the meaning will be the opening position on hand, and also it represents the amount that the contract need to be closed at the expiration. So for these options which have 2 months until expiration, there's a lot of player in it. You can check on the open interest. The player already involved and they have a 1,650 contract on hand. So if you want to buy in now, there will be seller to you. And even though you want to get up, there will be a buyer to get from you. But if you check on the volume, you can see that the volume actually is concentrated just across 2 strike price. So it will be a very limited choice for you because you can only place the trade with a limited strike price, and it may not be a very good favor for you. So in this case, we abandon the options for UBS. Even though UBS itself is a very good share to trade off, have a high volume, clear directions, but the option doesn't give us a very good opportunity to get in. The one that have a 45 days until expiration have no trading volume at all, so we cannot get in and get out. And for the one that is going to expire in 66 days, even though there's a high opening position right now and a high trading volume, but the trading volume actually concentrated across just 2 strike price. So if you want to get in now, your choice is limited, and we would like to avoid that happen. And even though UBS is a very good share, but the option is not delicious. So for this case, we will just move on to another share. Okay, let's look at the second share, Palantir. Palantir have a rating of strong buy, which means that we only look for a call options. And the current price fall on $58.39 with a premium of $4.70. Okay, now you look for the Palantir stock and you go to the options, and we are still going to choose for the option is going to expire for 1.5 months or 2 months. Make sure that you are choosing the correct options. And in this case, we are confirming that we are choosing the option for Palantir. And the one that is going to have expire in 1.5 months actually have an open interest of 391. So for us, beginner that is starting low and cheap, actually this kind of open interest is already enough for us. Since you are not going to trade for multiple contract like 100 contract, 50 contract. So if you want to just trade with 1 to 5 contract, this is a perfect match because 1 to 5% just take a very small percentage among the opening positions. So it depends on the contract size that you are going to open. Since we are going to start low with 1 to 5 contract, a 391 contract opening position is actually sufficient and enough for us to start with. And we also check for the volume. You can see that the trading volume is actually very active across different strike price. So in this case, in the liquidity itself, we are safe to get in and get out. So Palantek on the liquidity, I will give it a tick mark. It passed on the liquidity test. And we want to comparing either the one that is going to expire in 45 days is better, or the one that is going to expire in 66 days is better. And you can see that actually the one that is going to expire in 2 months have a higher trading volume and a higher open interest, which means that the liquidity for those for the option that is going to expire in 2 months is actually have a higher liquidity when comparing to the one that is going to expire in 1.5 months. So if you have you tend to trade for a higher amount, which more than 5, I would say, like a 10 contract, a 20 contract, a 50 contract, or even a 100 contract. The one that is going to expire in 66 days will be a much better choice for you. But there is pros and cons. The price itself is also different. The one that is closer to the expiration date will tend to have a cheaper price, and the one that is going to have a further expiration date will be more expensive due to the time value. And the time value, we already discussed it in the previous class, and it's up to your choice. If you have more money and you tend to have access to higher liquidity, then you can go for the one that have a further expiration date. But in this case, since we are the beginner class, we need to start small and slow. So we will going to just focus on the one that is going to expire in 45 days because it is much more cheaper. Okay, now we will look into the detail of the options. Since we already know the liquidity have no problem, a tick mark for the liquidity, we can get in and get out without any problem. Now we need to look at the other factors. The first one that I will look at is the spread across the bid and ask price. And in this case, the ask price is $4.95 and the bid price is $4.65. What does it mean? It means if you want to get into the position right away, you will need to pay for $4.95 and you have an immediate loss of 30 cents. The spread is around 6% in this case, and which means that if you buy in $100 for now, you will lose $6 immediately at the moment that you get into the positions. And for me personally, my tolerance for the spread will be around 5%, which 6% is actually also okay since this is highly traded, have a high liquidity, and is an active stock. So 5% will be the most suitable spread for this filter. Okay, second, we look for theta. And you can see that the theta is actually negative 0.051. What does theta mean? Theta means the time decay across the time. And in this case, the premium is selling on $4.80. I think the average above, in between the bid and ask, just so the price will be $4.80. and then a 5 cents time decay, which means that across one day, the $4.80 premium will be dropping to $4.75. So in this case, if you do the mathematics, you already know that the time decay is actually 1% each day in this case. So if you bought in the contract and the price do nothing, just remain stable, and you will need to experience a price decay of the depreciation of 1% every day. So you need to make sure that the gain that you get is much more greater than the time decay. So in this case, a 1% depreciation across the day, I think this is perfect. Me personally, I will just also give it a 5% decay. So also a tick mark for the time decay. And now you need to check on either this premium is on a very expensive zone or a cheaper zone. And you can check on the implied volatility, because the higher the implied volatility, the higher the premium price. And in this case, Atlantic, and in these options, the implied volatility is 54.22%. And how do we know that is it above the average, on the average, or below the average? When it is above the average, which means that the current premium price is actually expensive than what it should be. If it is below, that means that this is a cheap options to buy in for now. Okay, so this will be my personal method to check on the implied volatility for an individual stock. Still going to tradingview.com, and then you can just add on the indicator called implied volatility. And for the Atlantic, you can see that the implied volatility actually across 0 to 80%. And then it have an average of the medium rate of 40. So I would say that 40% IV is actually a very good benchmark for this Atlantic. So now with a 57% IV, this Atlantic options is actually way more expensive than it should be. Okay, so we need to do the math. So in this case, the implied volatility is 54.22%. And then the medium rate for Atlantic is actually having an IV of 40%. So what we need to do? After we do the math, how do we calculate it? Is we're using the Vega. We already learned how to use Vega to calculate the effect on the premium price. So we will just multiply by the Vega times the difference in between the implied volatility. In this case, we are using 54.22% minus 40%, which is the medium rate, and then we times on the Vega 0.084, and then we deduct it, because for now the current share price of $4, the current premium price of $4.80 is actually expensive because it's response to the IV of 54%. So we will get to deduct it, and then you will get to know that if the IV now is on 40%, this premium should go for $3.59. And that will be a $1.20 difference in between, just because of the IV. So now this option is actually way more expensive than what it should be. My personal suggestion will be, you need to wait until the implied volatility to get back to the medium, or even better is below the medium. Then you make sure you are confirmed that you are buying at a cheaper rate when comparing to the market rate. So even though for these options, the spread is good, the time decay is low, and there is a high volatility for you to get in and get out, but this share price is actually way more expensive than it should be. A $1.20 difference higher than it should be. So my suggestion will be you wait for the IV to drop below 40% for an entry, because we want to buy low and sell high. And the last thing you will check on is the risk to reward ratio, the data comparing to the delta. The delta is the rate that is going to depreciate every day, and the delta is the premium increase for every $1 increase in the share price. So you will check on the risk to reward ratio, and you can know that the risk to reward ratio is actually 1 to 10.7, which is very high. So if this Palantir is go up $1 in today, you are actually making a 10 time profits when comparing to the time decay. Okay, so this is a little hints on how you choose the options. Now you already know how to choose the options based on the liquidity for you to get in and get out. You check on the open interest and also the volume traded across different strike price. This is the first thing, the liquidity, just to make sure that you get in and get out without any problem. Next on, you check on the immediate losses, which is the spread in between the bid and ask. For the last case, 6% spread, which means that you buy in $100, you will lose $6 immediately. And my personal suggestion will be 5% for a maximum spread. But if the stock is good, then 6% to 7% is also acceptable. And then the third one, you check on the time decay. You make sure that the depreciation is in an acceptable range. And then you check on the status of the premium price, which is from the IV. The higher the IV, the higher the premium price. And then you need to check on the average IV that this price fall on, and then you know that what is the price that this option should be worth now. Okay, four of them now. And then you check on the risk to reward ratio, which is the delta to the data ratio. This is how you're going to choose the options. And then this is a little bit tips on how do you choosing the option for different strike price. If you are very confident in the directions, in this case, the Palantir, the trading view is suggesting a very strong upward movement. So if you are very confident with the trade, you can go with the lower delta, because delta, in another meaning, the market will say it represent the winning rate of these options when it reach the expirations. So in this case, you can see that for different strike price, they have a different winning rate from 38% to 68%. So it's all up to you. If you are very confident, you can choose the one with a lower win rate. But if you're not confident, you can go with the one that is higher win rate, but the price will be different. So in the Palantir, first of all, we filter out the share, and then we found the diamond on hand, the 4 share that is cheap and then have a clear direction and highly traded volume. And then we look for the options. And in this case, the spread is good, the time decay, the delta is good, but the IV is bad. It's way above the average now. So the risk to reward ratio is also good. So for this options, the best solution is to wait for IV to drop to 40. This is how we choose the options. So in this class, let me summarize what we have go through so far. First one, we learned about how do we use TradingView to do a share screener, a stock screener. We make sure that the stock have a higher market cap and have a high trading volume and also have a very clear direction. It's not ranging, it's not reversing. If you have a very clear direction, either we need to buy long or buy put. So clear directions and volume is the most important thing. Then once we have choose the diamond among the financial market, we choose the most suitable share. We need to check for the options because option can provide you the leverage. And how do we choose the option across all of those? First of all, we check for the liquidity. And then we will check for the delta, the IV, and all those, just like what we have talked so far. Okay? So we need to make sure that the option itself is good and it is undervalued now. In this case, the Palantir option is good. Palantir share is good. The option is good. It's just that it is a little bit expensive that it should be right now. So the best scenario will be wait for the option price to drop along with the IV. So it will just when the option price allocated around $5.60, it might be a good entry, but anything that is lower will be much more better. But do pay attention to it because there are many factors that is affecting on the premium price. So even though in the future the IV drop below 40, you need to check on all of those things again and again because everything will change together. So if in the future the option price drop to way below $5.60, it may not be a very appropriate entry also because it may be drop along with the IV or it may be drop because of the time decay or the share price. So it depends. You need to check on all the conditions again and again every time you access to the share and also to the options. This is how we do the screening on the share and also on the options, which is the first step to make the money before we make any trade, just to filter out the best share and the best option from the financial market. Okay, so we already covered many things, and at last I will just share my personal contract, which is my official contract at VCom, and you can add me from VCom using WeChat. I will just post my QR here, and there's a benefit to open an account in uSMART right now. If you open an account right now in uSMART, you are able to get the free share of Tesla, 0.0 share of Tesla. And if you deposit more, you're able to get more cash voucher. If you are a new user and you want to register, you want to start on your trading journal, feel free to register through the QR. So in Friday class, I will talk about how do we make a rocket money using options and what does it make a difference when comparing to a very steady wealth accumulations. Because rocket money is actually what people looking for when they come into options. So now I think after we go through all those like screening and the theory and all those knowledge, I think it's a very good timing for us to step into the underlying theory of why the rocket money happened in the options. I will go through the basic theory of why this rocket theory is happened and how are we going to catch it with mathematics. So if there is any questions for this class, if there's no questions for these sections, then we will just end the lesson for today. And then hope to see you guys on the next class on Friday. And last, I will just share my disclaimer to avoid any